Welcome to the Clear to Close podcast with your host, local mortgage expert Ryan Bolton. Ryan has the questions and answers, tips and tricks, do's and don'ts, and expert guests to explain all the steps needed to buy or sell real estate. And now it's time for the Clear to Close podcast.
Hey everyone, my name is Ryan and I am a mortgage nerd. And I work with Patriot Home Mortgage here in southern Utah, St. George specifically, but I do lending throughout the whole state of Utah and the state of Nevada. That's where I'm licensed. We have other loan officers at Patriot that can help you in other states. So if you have any real estate needs when it comes to financing a home, we can help you. We can do everything from first mortgages to home equity lines of credit. We also offer purchase, first-time home buyer to people that are upgrading or downgrading. We do private money lending. I often tell people, it's kind of a joke a little bit, that I sell money for a living for real estate. So we have lots of different ways to help you into a home, to help you buy, real estate development, private money. There's all kinds of fun ways. And I've been doing home loans since 1999. So I've seen and done it all and really enjoyed this industry that I've been in for so long. Also, a little side project. You can see I've got kind of a new hat here today. This is my little nerd hat, and I've got the little hoodie that I've worn a few times. Let me see if I can get in the camera there. It's just kind of a fun, I like nerding out on all kinds of different things. And so I thought I'd create some shirts and some hats that'd be just kind of fun to show off your inner nerd. So I've got these different categories like car nerds and book nerds and comic book nerds and just some that just have nerd spelled a couple different ways. So the top line there is what I call the OG nerds. That's just kind of not necessarily a particular category that just has nerd in a couple different ways. So check it out. It's nerdmerch.com, and nerd is with a 3 for the E, just kind of a gamification, gamer tag kind of thing by replacing the E with the 3, and just thought that made it kind of even nerdier. It made it even funner to have the nerd spelled with an E. So there's all kinds of different categories. I'm always adding new different stuff to mugs and hats. It's kind of got a little story there about how nerd came about. And it's not a huge profit thing. I don't try to mark everything up like crazy. I just think it's kind of fun to be a nerd over things, to just nerd out and get really deep and heavily involved in thinking things through. And I'm always reading stuff, watching YouTube channels, watching stuff that's just kind of cool. And so I just like nerding out on stuff. So check out the hat, see if you have somebody you want to get a nerd hat for at nerdmerch.com. And again, nerd is N3rd, nerdmerch.com. So today, for today's podcast, I want to do just a Q&A. So we've got the producer here, Mr. Freddie Mac, is going to load up a couple of mortgage questions, and we're just going to go through on the internet and some other questions that were posted and just see what kind of questions we can come up with. So what's our first one?
Alrighty, what stops someone from buying a house with a mortgage and having the tenant pay the mortgage in their rent? Why not do this with 50 houses?
Oh, okay. Yeah, so you can buy investment properties and have somebody else make that mortgage payment in rents. Why you can't do that with 50 houses is you can't get 100% financing for investment properties. So usually there's more down payment requirements. There's also different debt ratios that you have to factor in because you're still obligated for that payment. Even if you have a tenant that signs the lease, if they don't make the payment or they miss the rent payment or they damage the home, it still falls back on you. So for lenders, we're going to want to see a little more skin in the game. We want to see a little more experience of being able to be a landlord. And most commonly, you're going to have the debt ratio and down payment requirements that are going to restrict how many homes you can buy. But there's nothing to say. There's a lot of people that have many, many, many rental properties. It usually comes down to having to kind of build that portfolio because of down payment requirements and monthly income. One other thing is Fannie and Freddie have guidelines once you have more than 10 financed properties. Once you get past that, certain lenders just don't loan to somebody that has more than that. Now, you can own more homes, so they could be free and clear, or you could try to move money around. But generally, you run into a lot of restrictions when you get past 10. There's kind of guidelines for the first 4, then for the next 8, and then up to 10 that change to get a little bit more strict, a little bit harder, a little more money down, higher credit scores as you're trying to build an investment portfolio. But there's really nothing to stop you other than having the money to put the down payment. You could have as many rental properties as you want as long as you have debt ratio and down payment for that. So good question. What else we got?
All right, next question. I heard that completely paying off your house mortgage is unwise. Is that true?
It depends on where the money's going to go. I'm a big believer that the tax benefits, the longevity of a loan, the locked-in fixed interest rate is better to have that debt than, say, other types of debt. And again, you cannot sell or you can't get your equity without selling or refinancing the home. So having that money liquid or being able to invest in other things, get rid of other debts it's more of an overall look of where else that money can go. So I have a lot of people I've seen that just put everything they can to pay off the house so it's free and clear for retirement. Where if they would have taken that same amount of money and invested, got rid of other debts, they'd probably be further ahead than just a free and clear home. So there's not a silver bullet for all these things. And obviously I'm in the lending world, but I do real estate investing. I have rental properties. I've really tried to leverage that in a way that makes sense with cash flow and just be able to free up that money. But that's the biggest thing I said. You wouldn't take all that money and put it in one gold bar or one stock or one bond. Yeah, you would do it all into one house. So there's ways I think you can diversify that money depending on the interest rates you have, depending on cash flow. I don't think always it's the best decision. Now, some people might be different. That's why to say universal for every person that it applies, I don't think so. But generally, I think you should look at where else can that money go that keeps it more liquid, that earns a better rate of return, that gets rid of other debts at higher interest rates. There's more ways to use that money than just putting it all into one mortgage or one property is the way I would answer that.
All right, next question. How can I get a mortgage with bad credit?
Boy, isn't that crazy, Freddie, how often that is a question that's on these websites all the time.
I have less and I want more.
Yeah, and it's something where it's like, yes, there's somebody that's going to loan you money. We got loan programs for 100% down to a 620 score. So there's kind of two things I think happen with this question. Is some people think you have to have perfect credit to get a home loan. You're talking hundreds of thousands of dollars. They think you have to have better credit than you really do. So there's definitely a wave of people that think, oh, I've got to have a 700 score to get into a home loan. But then there's another wave that says, I've got a 400 credit score. I want to go get a home loan. So there is a balance between those spectrums. But the short answer is yes, there's people that will loan you regardless of credit, regardless of all that. But the rates and terms are going to be a lot worse. So I always sit down with people that have credit issues or credit questions and say, let's work on getting the score up a little bit so you get a better loan. By getting a better loan, you'll have either a cheaper payment for the house you're looking for or your buying power goes up. Because as the interest rate goes down, that $1,500, $2,500, $3,500 payment buys you more home. So it is important to know how your credit works, why it's the score that it is. And all of us have had mistakes in our past, and we bury our heads in the sand when we got a bad credit card or turned in a cell phone or an internet company. I mean, all kinds of stuff. I see medical collections, all kinds of things where people just kind of forget about it, bury their head in the sand. They let their credit go down until they actually need it for a car loan or a home loan or anything. But so many things tie to credit. Insurance, jobs, employment. It's amazing how much ties into that. And if you don't know how it works and you don't know why your score is the way it is, you might be missing out on getting the score improved or just raised up. And I can't tell you how many times I've sat with a client that within 30, 60 days, we can get their score up. Getting to 620 is not crazy hard. It will take some time depending on why your score is the way it is. But sitting down and going through that with me, I can kind of give you a free review and say, go work on A, B, and C. And within 6 months, you could see a much, much better credit score. So the answer to the question, can you get a mortgage with bad credit? Well, it depends on how bad. But answer is yes. But do you want that loan? Probably not. Why not work on getting the score up so you get better loans? So that would be my answer to that. So if you're struggling with credit, if you have some credit issues in the past, if you haven't even checked your credit in a while and you just know there's ugly stuff on there you've just been ignoring, put your head in the sand, let's deal with it. Let's jump into it because that credit score isn't just for mortgages. Car loans, insurance, there's so many things that tie to that credit score. Having it be more true or representative of your situation is only going to help you with your finances. So work on your credit. Okay, what else we got?
Okay, next question. What are the different types of mortgage loans?
Oh, boy. There's a lot, just like there's what's the different types of cars, what's the different types of trucks. There's all of them have different needs and different things. The most common you're going to run into is what's called conventional loans. These are Fannie Mae, Freddie Mac. They're kind of A paper. They set a lot of the guidelines for what's called a conventional loan. The next set of loans is what they call government-backed, where government insurance or government-backed loans don't actually loan the money. So it's not the federal government, the taxpayer loaning the money, but they're setting guidelines and basically setting up insurance funds that if those loans go bad, the investors are covered. So I would say most loans are going to fall into those two categories. And if they don't, there's a whole nother category called non-QM, which used to mean subprime. It's basically the loans that don't quite fit government-backed loans and don't quite fit conventional loans, but there's still a need in the marketplace for that type of borrower. So really, I would say outside of lines of credit or private money or institutional type stuff, it's got to be 90+% fall into one of those three categories: conventional, government, and non-QM. And the non-QM space is where you're seeing a lot more holes are being filled by that space, because there is make sense loans. If you got somebody that's got a 700 credit score, he's self-employed, but he's had a lot of write-offs and doesn't qualify, the non-QM can help that borrower actually get into a home or get to refinance. So those are the type of loans that are out there. And then within those types, you're going to have different terms. You're going to have 30-year fixed. You're going to have adjustable rate mortgages. You're going to have different guidelines that determine if you qualify for those loans, and the interest rates are going to be different within those tiers. Or if it's a 15-year fixed, I mean, there is a lot of little things that kind of spider their way down, kind of tree their way down from those top three. But generally speaking, those three are going to cover almost every mortgage in the U.S. is conventional, government, and non-QM.
Okay, next question.
Great question.
How are mortgage interest rates calculated?
Oh, okay. So just like insurance rates will determine based on risk, will change what interest rate that you get. But there's always kind of a par or a base rate that's going to be available. And most of that's going to be based on the bond market, or what's called the mortgage-backed security market. So that's where you determine kind of what the available rate is of the day. Then you're going to have adjustments to that rate based on risk. So you're going to have, okay, what's the occupancy? What's the credit score? What's the debt ratio? What's the term of the loan? All those will be factors that will kind of add to that base rate. So the base rate's kind of what's available in the absolute perfect scenario, and then it has what we call hits or price adjustments that go up or down kind of based on the risk of the loan. So that's why there isn't just the rate, the 30-year fixed rate for everybody, because everybody's risk is a little bit different. Everybody's need for the loan is a little bit different, from occupancy to property type to term to job to all kinds of different risk things. So it's very much like insurance, to where, okay, what is the risk if we have to foreclose on it? We have to offset that risk with interest rate or fees, one or the other. So that's why you don't see typically an actual rate for everybody, because everybody's situation really is different. So that's part of my job, is to say, okay, let's get your scenario to make sure I'm quoting you the most accurate rate. And just like any other marketing you see out there, whether it's car loans or mortgage loans, a lot of times they're advertising that lowest possible rate. That's usually somebody putting 30 or 40% down with 900 credit scores, with a debt ratio at -2, and time on the job has been of 50 years. I mean, these are all things that really lower that risk. So there's a very famous billboard in town that everybody kind of mentions as you drive by on I-15 that has like their proposed interest rate. Look at the small print. There's a lot of things about that small print that not everybody's getting that rate. Just like on the car loans, if you see Mercedes or Cadillac or Toyota advertising an interest rate, most people realize not everybody gets that rate. That they're trying to advertise their best rate they can offer and make adjustments as needed. So that very same thing happens with interest rates. So that's why you see a lot of mortgage companies don't advertise a rate, because there isn't a rate for everyone. And I don't like setting out an interest rate that's the lowest we can possibly get when I know that 9 out of 10 people coming in the door aren't going to get that rate. So it feels kind of bait and switch to me. And you see a lot of lenders, there's a lot of rules on interest rates, on what you can advertise. So that's why you generally say, let's get in, let's do a free analysis and say, here's the best rate available for your specific situation. But that's kind of how rates are calculated, is based on the bond market in many cases.
Here's a weird question. So I was at an airport lounge the other day, and just kind of making talk with the people around me, and one of the bartenders does mortgage lending.
Okay.
And so as part of the conversation, I said, so what are we at, about 7.5 now? Is that kind of the rate? And she's like, well, legally, I'm not allowed to say. And I'm like, you're just getting me a sandwich. What's the deal here? So why can't...
Right.
Why did she say that to me?
So in mortgage lending, the interest rate you get is not the APR. By law, if we disclose or advertise an interest rate, we're also supposed to disclose the APR. An APR is basically taking the fees to get the loan as part of a percentage term. So it's something where it's hard to advertise a rate without also advertising the APR. So you have to be careful how you phrase it, and the fact that you may not qualify for that rate. So you have to then say, on approved credit, that there's a lot of laws on what we can actually advertise an interest rate. So you see a lot of lenders just pull back and don't want to get caught with a fine or a penalty for misquoting or not doing the correct interest rate. So usually that's what I say. Just like you said, the average interest rate right now is right around this. Interest rates can differ. You do have to kind of throw that disclaimer out there. But if somebody's bartending and doing mortgages, maybe they're kind of doing both on the side, and so maybe they haven't spent as much time doing it. But that's kind of the reason why. There's so many laws that regulate my license, that regulate what you can and can't say. We're not maybe as bad as like financial planners, but we've got a lot of restrictions. So when you see real estate agents advertising interest rates, that's where they kind of start getting out of their lane. And there's a lot of things they're supposed to do if they advertise that interest rate. Even if I advertise a payment, it triggers. They call them triggers. Once I do something, it triggers all the other disclosures that I have to do. So that's why it's very tricky to name a specific interest rate without being like, okay, this is today's average. This is where it's from. This may not be the rate you actually qualify for. So it is a sticky little thing just because of advertising laws more than anything.
All right, next question here. I just found out that my landlord filed Chapter 7 bankruptcy. Is it unethical or immoral of me not to pay rent anymore since he is not paying the mortgage?
Wow, interesting. Yeah, so you signed a lease with that person. He signed a note with that mortgage company. So it really just comes down to whether you sign the loan that you do owe on that particular property, regardless of what he does with the property. So if he didn't have a mortgage on it, would you still make the payment? It's just because now he doesn't have a mortgage that you don't have to make your rent payment. The other thing to consider is if you don't make your rent payment and you try to go rent somewhere else, now you have bad rental history. So regardless of what he does with your rent money, you still are obligated because you signed a lease for that particular property. So I think it's better to make that payment. It's also better to try to move out, or you can try to get out of the lease or something like that, or renegotiate with him if he's not making the payment. But it's a sticky issue because, like, yeah, he's not making his mortgage payment. But if the property was free and clear, you'd still owe the payment. The only reason you wouldn't is because he's not making his debt obligation, and he's possibly going to lose that property, especially if it's in some sort of bankruptcy. But the money that you still owe, you still sign the lease. It's still something where you should do it because it can actually hurt you as well when you go to rent somewhere else. Now, what I've also seen is some of the lenders will give you cash for keys. They'll allow you to continue to rent the home because they'll end up taking over that property if you continue to make your payments. But as soon as you stop making your payments, I think it'll have more of a consequence to you than you may realize, regardless of him not making his payment. But it does happen where people don't make their mortgage payment. That's why us as lenders, we have higher interest rates for investment properties. We have more down payment requirements because of that extra step in between of how the payment actually gets made. But a short answer, I think you're still better off to make the payment. You sign that lease. If you don't make the payment, it can hurt your history, maybe hurt your credit, hurt your ability to rent again. You'll have to always explain, well, I stopped making my payments because he wasn't making his mortgage payment. They'd be like, well, but you signed the lease. You said you were going to make that payment. And I have seen more times where people do make their payment or continue to do it, that they're able to work out better situations with the new owner, with the new investor that takes over that property, instead of just being evicted because they hadn't made their payment. So I think you're better off to make the payment. You signed the lease, you should make the payment.
All right, next question. This is I don't know, maybe kind of somewhat dated one, but okay. I feel like it's happened this year. Why did mortgage rates jump around and raise so fast? Right. Why are we all of a sudden at 7.5?
Yeah, so much of it is inflationary costs, prime changing, the bond market changing, the cost of everything else has gone up as well. So the interest rates had to offset that. So we've been pretty stable, I would think, for a year, but there's a lot of talk that interest rates should actually come down because typically mortgage rates are about 1.5% above the 30-year bonds. And right now we've been floating at 2.25, even 2.5 at places. So we've definitely got more kind of built into interest rates than there needs to be because there was so much movement and so much uncertainty. But mortgage rates are very similar to any other commodity, any other stock, any other bond out there. They move daily. I mean, I have a little candlestick thing that just kind of shows where the bonds are going every single day to kind of get an idea for my clients. Should we lock now? Should we wait? What's the recent trends? What's the last 10 days? Just to try to stay ahead of any of this. But a lot of it is just like any stock, any bond, any commodity. It's going to go up and down based on the demand, based on where other money is shifting, the cost of other money sources. It's all part of the money system is how it works. So it was scary to see it go up as quick as it did. It's been pretty stable. We have been pushing closer to 7 when we're kind of maybe in the 6.5 range for a lot last year. But there's a consensus that a lot of that hedging, a lot of that kind of baked in bond price that's a little bit higher than what we see should work itself out. But that's been a conversation for almost 6 months now. So maybe this is the new normal. Maybe the bonds will be closer to 2% instead of 1.5%. But If you look at like 70-year average, it's about 1.5%. So it's a long snapshot that we're above that average. So hopefully we'll see that kind of flush itself out. But I tell you, inflation's been really sticky. They've been trying to get that target number now for many, many cycles, many, many quarters, and just can't quite get it to where they wanted. And they really have dialed back the Fed adjusting interest rates. So I think we're pretty much going to stay, I think, kind of in the 6 range. And if you look at the last 70 years, anything under 7% is below a 70-year average. Now, we got spoiled with 3 and 4% interest rates for so long, but even taking into consideration those interest rates, it's still about a 7% average interest rate over the last 70 years. The downside is our home prices weren't $400,000 and $500,000 at that interest rate. So there's definitely some forces out there that are keeping rates the way they are. Really, we have to increase our supply is probably our biggest thing, to be able to kind of absorb some of that money to help with interest rates. But they've been that way for quite a while, and I think they're probably there to stay for at least the next maybe 2 or 3 quarters.
All right, next question. Is real estate a viable option to accumulate wealth?
Absolutely. It's one of the few things that you can buy with 100% financing that is an appreciating asset. Think about that. If you're trying to buy a stock or a bond or a crypto or a car, or, anything that has any kind of appreciation to it. A car is probably a bad example, but anything that has kind of that market up, crypto or stocks or bonds or anything like that, mortgages have an opportunity to leverage with financing that you can't get anywhere else. 30-year fixed rate money. It's just amazing to be able to do that. And the fact that you can buy it and still gain that appreciation while you're actually using that asset as a monthly payment, because you're going to have a monthly expense typically anyway, whether it's rent or a mortgage, but now you have a mortgage that also adds to that appreciation. It's one of the best wealth-creating tools that have been in the country for most people. In fact, most homeowners have a net worth that's about 6 times more than a renter because of that natural appreciation. Now, a lot of people think, well, maybe I missed out on the wave. You talk about appreciation, but I missed the bubble. I missed the opportunity to do that. But real estate really is designed as a steadier raise in appreciation than these big spikes. But it's one of the things, you already have that housing expense. Now you can put the housing expense into an appreciating asset that can grow over time while you're making that payment without having to pay 100% of the price of the house. You can get 100% financing, or as little as 3% down. You can acquire that entire asset and all the appreciation that comes with it, while still having a housing expense that now actually goes somewhere. So I'm a big believer in real estate. I've been through the 2008. I've owned homes for most of my life. I own multiple homes right now as rentals and cash flowing properties. And I'm a big believer in real estate because of the ability to leverage, the ability to not have to pay 100% for it, to have cash flow each month. I think real estate's a great way to go. I really do. I think the more you can build that portfolio, the better you are, instead of just paying cash for one house.
What does your credit score need to be able to buy a house?
Okay. So it depends on how much money down, but generally I would say
0. We'll go back to
okay.
I'm poor, I have bad credit,
okay,
and I have no money.
620. Really, if you can get to 620, so many doors open up for 100% financing and better rates and terms. The next tier is 660. Once you get past 660, there's not huge differences until you have down payment money. Because once you have down payments, you can change from a FHA to conventional, which does have cheaper mortgage insurance, depending on the credit score. But the low end, I don't know very many programs that do 100% without at least a 620 credit score, which is not that crazy hard to get if you know why your score is the way it is and what to do to build it and make those types of things. So it's not like you need a 700 score to get 100% financing. But the short answer is 620 is really where a lot of these things open up. 660 is really the next tier, and that's my goal when I'm sitting down with a client that needs 100%. What can we do over the next 2 months or however long we have to work on getting that score to the 660? In fact, I just had a client, they were like a 637, gave them some tips, did all that. We just pulled their credit on Monday, and they were right at 660. And it changed their interest rate, their payment, their ability to buy a bigger house. I mean, it just changes so much. If you can get to 660 is really the magic score, but the minimum would be 620. Otherwise, you're going to have a down payment if you're under a 620 credit score.
I think we have time for one last one
great.
here. Okay, my credit score is right around 800. I always pay on time. I use a little portion of my credit. How come I don't have a perfect 850 score?
Because it's really interesting there. There is 3 different scoring models that don't have 850 as the top number. And I pull a lot of credit. If you have 3 scores in the 8s, like I very, very rarely see that. Just like infinity is mathematically possible doesn't mean we're going to get there. So the algorithm to get it to the perfect score is almost impossible. But if you're over 740, you're A+. I've only seen maybe 2 or 3 times in my entire career all 3 scores in the 800s. It's very rare.
Hey, can we run my credit? I want to see if I'm up there.
Yeah, we should. Let's do it. So I really appreciate this podcast. I think it's a lot of fun. Keeps me on my toes to answer questions. If you need help with a home loan, go to ryanbolton.com. I can help you in Utah, Nevada. Love an opportunity to work with you on buying, refinancing. I really like what I do for a living, and I want to work for you and get you into a home loan. ryanbolton.com. We'll see you next time.
This has been the Clear to Close podcast. Please submit your comments, questions, and topics for future episodes to cleartoclosepod@gmail.com. That's clear the number 2 closepod@gmail.com or ryanbolton.com. Please like, follow, and share. And until next time, this is the Clear to Close podcast. The views expressed in this podcast do not necessarily reflect those of Patriot Home Mortgage, Equal Housing Lender, NMLS number 299717. This has been a production from a podcast studio.